Imagine you are planning a trip abroad. Or maybe you're just looking at the cost of your favorite imported electronics online.
Right. Always a painful experience these days.
Oh, absolutely. Suddenly you notice your money just isn't going nearly as far as it used to, and you're wondering why. Well, it's because the Indian rupee has touched historic lows recently, hovering right around that 94 to 95 mark against the US dollar.
Yeah. It's a number that has a lot of people paying very close attention right now.
Definitely. So, welcome to today's deep dive. We are looking at a really comprehensive stack of economic lectures and analyses today to figure out what's going on.
And there's a lot to cover.
There really is. Our mission for this deep dive is to cut through all the dense financial jargon and unpack exactly why this historic drop is happening, how this massive global chess game actually affects your wallet, and what it genuinely takes to fix it.
Because it's not just numbers on a screen, it's real-world impact.
Exactly. So, okay, let's unpack this. Before we can diagnose the disease, we need to understand the anatomy of the currency market, right?
Yeah, we have to separate what the market is doing from what the government is doing. That's crucial.
Right, because I see these two terms thrown around interchangeably all the time, depreciation and devaluation.
Oh, constantly. But mechanically, they are entirely different animals.
Mm-hmm.
Depreciation is when market forces, basically just global supply and demand, weaken the currency.
Okay, so it's organic.
Right. Devaluation, on the other hand, is when the government or central bank intentionally lowers the value of their currency.
Like they actually pull a lever to make it worth less.
Exactly. India famously did this during the 1991 economic crisis to boost exports. But right now, what we are experiencing is extreme market-driven depreciation. Nobody is intentionally lowering the rupee to 95.
Got it. I like to think of the supply and demand of currency kind of like a relationship.
Oh, relationship. Okay, I'm listening.
Yeah. Like if you are always available, constantly oversupplying your time, your perceived value might drop. Right?
Human nature.
But if you are in high demand and short supply, your value skyrockets. So right now, the world demands US dollars, and India is just constantly supplying rupees to get them.
That is a remarkably accurate analogy, actually. The world demands dollars.
Which brings up something so fascinating from the sources we reviewed. Here's where it gets really interesting regarding who actually supplies those rupees.
The printing mechanics.
Yeah. So you'd think the Reserve Bank of India, the RBI, controls every single piece of currency. And they do issue most banknotes. They can even legally print up to a 10,000 rupee note.
Which is wild to think about.
Right. But the 1 rupee note and literally all the coins in your pocket, those are actually issued directly by the Ministry of Finance.
Yeah, it's a really fascinating quirk of the Indian system. It shows just how meticulously the physical currency is managed internally.
But wait, if the state has so much control over printing and managing this currency, are they just sitting back and letting this free fall to 95 happen?
Well, no, they aren't just sitting back. India operates on what's called a managed floating exchange rate system.
Managed float, meaning the market drives the car, but the RBI can hit the brakes.
Exactly. The RBI doesn't permanently fight the market trend, but they intervene to stop chaotic volatility.
Yep.
But right now, the market forces are just overwhelmingly strong.
So the market is basically throwing the rupee under the bus right now. Why?
Well, the sources identify a perfect storm. It's basically 5 compounding pillars driving this drop.
Okay, let's break those down. What's pillar number 1?
The first pillar is India's structural import dependency, specifically crude oil.
Oh, right. India imports, what, roughly 85 to 88% of its crude oil?
Yeah, a massive amount. And because international trade is almost entirely settled in US dollars, anytime there's a geopolitical conflict in the Middle East.
Like the tensions we've been seeing, which pushes oil past $100 a barrel.
Right. When that happens, India instantly has to dump more and more rupees into the Forex market just to buy those expensive dollars to afford the same amount of oil.
So we are just flooding the market with rupees, which leads right into the second pillar, the trade deficit.
The hard math. It's unavoidable.
Yeah, looking at the numbers, India imports around $700 billion worth of goods, but only exports about $440 billion.
Exactly. So dollars are just bleeding out of the economy significantly faster than they are coming in. It's a massive structural gap.
Which brings us to pillar 3, the global geopolitics we kind of touched on.
Yeah, wars and global uncertainty. You've got the U.S., Iran, Israel tensions, the Russia-Ukraine situation.
And when the world panics, investors don't want to take risks.
No, they seek a safe haven. And historically, nothing is considered safer than the US dollar. So everyone hoards dollars, which artificially skyrockets its value against currencies like the rupee.
It's just a systemic flight to safety.
Grr.
And speaking of the U.S., Pillar 4 is the U.S. Federal Reserve, right?
The Fed, yes. Their interest rate policies are a huge factor. They've kept their interest rates high, with Treasury yields crossing 4.4% recently.
Which is a guaranteed return for an investor.
Exactly. If you're a foreign institutional investor, an FII, you look at that guaranteed return from the U.S. government, and you pull your money out of developing nations like India.
Wow. And the sources mentioned that in March alone, an absolutely staggering $10 billion was pulled out of India.
Yeah, $10 billion. They just liquidate their Indian assets, convert them to dollars, and park them in the U.S.
Okay, so that's 4 external pillars. What about Pillar 5?
Pillar 5 brings it back home. It's domestic policy and inflation.
And just to be super clear, you listening, we are impartially reporting the viewpoints of these economic sources here. We aren't taking any political sides.
Right, purely looking at the economic data. The sources point out that domestic challenges, like sudden policy uncertainties regarding taxes or labor laws and high fiscal deficits, can really lower foreign investor confidence.
Because capital is cowardly, right? It wants predictability.
Exactly. And if you add domestic inflation to that, where the internal value of the rupee is dropping, investors get even more spooked.
Okay, so you have expensive oil, a massive trade deficit, global panic, high U.S. interest rates, and domestic inflation. It really is a perfect storm.
It is. It's an interlocking mechanism pushing that value down to 95.
But, macroeconomics is fascinating and all, but how does a shifting chart in Wall Street or Mumbai actually change the price of your groceries? Let's talk about the wallet impact.
This is where it hits home. The immediate danger is something called imported inflation.
Because an expensive dollar means expensive oil.
Right. And expensive oil means expensive transportation and freight costs.
Which means everything transported on a truck gets more expensive, especially food.
Exactly. Food makes up about 40% of the consumer price index basket in India. When diesel prices spike because of the exchange rate, your vegetables cost more.
That is brutal. And what about people directly dealing with dollars, like sending a kid to study abroad?
Oh, that's where the math is terrifying.
Yeah, if you were saving up for a $100,000 tuition, if the exchange rate was 80 rupees to the dollar, you needed 80 lakh rupees.
Right.
But if it jumps to 100 rupees per dollar, you suddenly need 1 crore. You're spending an extra 20 lakh just on the exchange rate penalty.
It wipes out savings overnight. And the exact same thing happens to Indian corporations that have foreign debt. Their loan repayments just became agonizingly expensive.
Wait. I want to push back on this a little bit because I've always heard that a weak currency is actually a good thing for exports.
Okay, the J-curve effect.
Yeah, like, doesn't China intentionally keep its currency weak for this exact reason? Why isn't India just getting rich off this discount?
It's a totally valid question. Theoretically, yes, a weak rupee makes Indian physical exports highly competitive globally. The problem is structural capacity.
Meaning we don't have the factories to take advantage of it.
Exactly. Because India lacks a massive China-style manufacturing base, it can't fully capitalize on the good side. You can't export what you can't produce.
Ah, right.
Right.
But, and the sources highlight this as a massive silver lining, there is one sector making an absolute killing right now.
The IT and services sector.
Yes, because it's a $300 billion industry that doesn't need physical factories. They bill U.S. clients in dollars, and when they bring that money home to pay salaries in rupees, their profit margins just explode.
It's a massive windfall for them. And it's also a huge win for non-resident Indians, the NRIs.
Oh, the remittances.
Yeah. If you're working in the U.S. or the Gulf and sending money home to your family, you are getting incredible returns right now. Remittances are actually expected to hit a record $140 billion.
Wow, $140 billion. So it really is a double-edged sword. It hurts the consumer and the importer, but it's a stimulus check for the IT sector and families receiving money from abroad.
Exactly.
So if we know the symptoms and we know the disease, what is the actual roadmap to fix this? Let's talk solutions. What can the RBI do right now?
Well, the short-term buffer is that the RBI is not powerless. They're actually sitting on a massive war chest.
Right, around $710 billion in Forex Reserves.
Which is huge. It's enough to cover 12 entire months of imports. So when there's extreme market panic, the RBI can occasionally step in and literally sell dollars from those reserves into the market to stabilize things.
Kind of like using a fire extinguisher?
Yeah, exactly. But they have to be super careful. They can't just burn through their reserves prematurely to fight a long-term trend.
Right, you can't fight gravity forever. And the sources also mention diversifying oil sources as a quick fix, right?
Yes, looking away from the volatile Middle East and trying to source cheaper crude from places like South America or Africa to soften the blow.
Okay, so that's the short term. But what does this all mean for the future? What is the long-term cure?
The long-term cure requires deep structural reforms to fundamentally change the math. First and foremost, boosting domestic manufacturing.
Which addresses that massive trade deficit we talked about earlier.
Right. Initiatives like Make in India aim to reduce that $700 billion import bill by making things at home and simultaneously increasing our capacity to export.
You have to build the factory floor.
You really do. The second structural fix is the energy transition.
Because we are just way too dependent on imported oil.
Exactly. The economy needs to aggressively shift toward renewable energy, scale up ethanol blending in fuels, and transition to electric vehicles.
Basically break the absolute dependency on foreign crudes so we don't have to constantly buy dollars to keep the lights on.
Yes, every drop of oil you don't import is a dollar you don't have to buy.
Mm.
And that leads to the third most ambitious long-term goal, internationalizing the rupee.
Oh, this is fascinating. Attempting to trade in local currencies, right?
Yeah. Instead of converting to dollars first, India is setting up frameworks, especially with BRICS nations, to trade directly. You buy oil from Russia or the UAE, and you pay them in rupees.
Which means we wouldn't be entirely at the mercy of the U.S. dollar's fluctuations or the U.S. Federal Reserve's interest rates.
Exactly. But it's a long, difficult road. Other countries have to actually trust and want to hold the rupee for that to work.
Man, it is such a complex web.
It really is.
I mean, we started out looking at a single number, the rupee dropping to 94 or 95. But it's not just a number. It's a reflection of oil dependency, the U.S. Fed, trade deficits, and global anxiety.
And it causes incredibly real-world impacts, from the price of your groceries to the profits of the IT sector.
It really connects the global to the local. But before we wrap up, I want to leave you with a final provocative thought. Something to mull over that kind of builds on everything we've discussed today.
Oh, let's hear it.
So, if the ultimate value of a nation's currency is a reflection of global trust and structural independence, what actually happens to emerging markets if a completely new global reserve system finally manages to bypass the U.S. dollar entirely?
That would change everything?
Right. Whether it's driven by a united coalition of developing nations or perhaps decentralized digital assets. If the world no longer needs dollars to survive, would the rules of this global chess game just be rewritten overnight?
The entire hierarchy of global wealth would shift. It's a massive question.
It really is. Something to think about the next time you check the exchange rate. Thank you so much for joining us on this deep dive. Keep questioning the mechanics and keep exploring.